Hey everyone, it's Hamish from the Young Investors Podcast. Myself and Brandon are excited to bring you your weekly rundown of the latest business and investing news from around the world. A quick reminder before we get started, any advice provided by Brandon is general and does not consider your financial situation, needs, or objectives, so consider whether it's appropriate for you. Brandon van der Kolk is authorised to provide general financial product advice in Australia and is authorised representative number 1305795 of Guideway Financial Services Proprietary Limited, AFSL number 420367. Please see the description box for Brandon's financial services guide. Past performance is not a reliable indication of future investment returns, but with that said, let's get into another episode of the Young Investors Podcast.
All right, guys, welcome back to yet another episode of the Young Investors Podcast. Coming to you live from the Swiss Alps.
Yeah, I didn't know that Perth had was getting snow this time of year.
Yeah, it's very snowy. Very
amazing.
snowy.
Yeah,
no, it's we got our lift passes for later on. We're going to hit the mountain and got my skis ready. Let's go.
Yep, the snowy mountains of Perth, Australia. Yeah,
exactly. Yeah. The skiing destination you've never heard of.
Yeah, exactly.
How you going, mate?
I'm doing pretty well. I went to the movies for the first time in a little while this week. I went and saw
Me too.
saw the latest Final Destination movie, which I would highly recommend. It's a very good movie.
Right. Okay.
So yeah, I hadn't really seen any of the Final Destination movies before the last couple of weeks, but then I knew I was going to go see the new one, so I went through and I watched all of them.
How many are there?
There's 6 now, so there's quite a few.
Okay.
But actually pretty good movie series, to be honest. I was thoroughly impressed.
Oh, nice. That's good. Well, I also went to the movies in the first time in forever last night, and I saw Lilo and Stitch.
Yeah, was it good? A bit of a different vibe from Final Destination.
Yeah. No, for what it was all right. I wouldn't have picked it. Let's put it that way. But it's not too bad. If you got kids, they'll love it. I mean, even me as an adult, it wasn't too bad. I wasn't getting bored during it. It was still entertaining enough. The kids will love it, I reckon.
Yeah, it's like a live action remake, right, of like the original one. Because I think I remember seeing the original a long time ago. But
I've not actually seen the original, so I couldn't even tell you if it's the same story or a different story to the original.
Right. Okay.
I've got no idea. But yeah, it was a live action. It was pretty well done. It was pretty well acted. Some of the scenes were pretty funny. But, overall, a good time. Anyway, welcome back to the Young Investors Podcast, everybody.
Staying on topic as always.
Staying on topic as always. Yeah. All right. So, in this podcast, Hamish, what do we have to talk about?
We have a couple of pretty big macroeconomic updates. I would say investing updates. We had a credit rating downgrade in the US. Which I'll talk through. I think we both have a little bit to talk about there. We had an RBA, Reserve Bank of Australia, rate decision this week. They've finally made a move for the first time since all of the rate increases that they did. It must be almost 2 years ago now. What else have we got?
I'm going to talk about, there's a logistics company that has recently been acquired. The ones that brought us Taylor Swift's Eras tour has been acquired recently for a very large sum of money. And there was just this interesting study that I found that caught my eye that actually showed most Americans don't want to live to 100. Which I thought quite interesting. They think like you. They just want to live fast and hard and peace out. But I was very surprised actually to see that the study suggests that most Americans don't want to live until they're very old. And there's an interesting reason for it, but we'll get to that later.
All right. Well, with that said, today's episode is brought to you by Seeking Alpha, your one-stop shop for stock analysis, market data, and news. Access expert analysis and news for thousands of stocks. View buy, hold, and sell ratings from members, Wall Street analysts, and Seeking Alpha's own algorithm. Screen for stocks using a variety of fundamental and technical analysis metrics. Access 10 years of financial data and company filings, and manage your portfolio by tracking your investments with price alerts, so you never miss a buying opportunity again. Click the link in the episode description or head directly to seekingalpha.me/young investors to try Seeking Alpha free for 7 days.
All right, tell me about this credit ratings downgrade. What's going on? I saw this pop up in the news, but I didn't read too much into it, so I'm interested to learn more because it's quite rare that this happens, I think.
It is. And so, the news that I think broke actually last week, I believe it was kind of the end of last week, is that the US has lost its last AAA credit rating. So Moody's Ratings downgraded the US government on Friday, citing large fiscal deficits and rising interest costs. So Moody's, of course, one of the big three ratings agencies, said expanding budget deficits means US government borrowing will rise at an accelerating rate, pushing interest rates up over the long term. The firm didn't believe that any current budget proposals under consideration by lawmakers would do anything to significantly reduce the persistent gap between government spending and revenues. And so, of course, this kind of growing and persistent US deficit problem, this kind of gap between government revenue and government spending, has been spoken about for a very long time. And so, it's been quite a persistent problem. In fiscal year 2024, the US government collected $4.9 trillion in revenue, but they spent $6.8 trillion they spent $6.8 trillion, which gives you a deficit of $1.8 trillion in a single year. And
if that was a company, if that was a stock, investors wouldn't be particularly happy.
No, especially this part, because not only were they in a deficit last year, they've been in a deficit for the last 24 years.
That's crazy.
Since the year 2000, they've been running a deficit. And so, if you're right, if that was a company, they probably wouldn't exist anymore.
They would have gone under a long time ago.
Yeah, exactly right. And on top of all of that, since 2015, the deficit has been rising at a pretty consistent pace. So if you take out the 2020 and 2021, there were obviously very excessive spending periods. But besides that, since 2015, it's been pretty consistent that every single year the deficit has been rising. And it's even projected in fiscal year 2025 to rise to $1.9 trillion. So... it's a pretty interesting and concerning problem, and now the latest news has been that Moody's has responded, which I'll get to the downgrade specifically in a second. Moody's wrote in a statement, successive US administrations and Congress have failed to agree on measures to reverse the trend of large annual fiscal deficits and growing interest costs.
Yep.
So the actual downgrade in particular, Moody's downgraded the US to AA1 from a AAA rating. And while this is kind of obviously a news story that's happening at the moment, it's not the first ratings agency that's made this downgrade. As I mentioned, they're actually the last to do it. So S&P Global, another big ratings agency, had already done this downgrade back in 2011. They actually did this downgrade, and the other big ratings agency, Fitch, made the downgrade in 2023. And so, while it sounds like a catastrophe, Moody's, the US loses their AAA rating. This is actually just the last ratings agency to do it.
So, I remember when Fitch did it in 2023. That was big news at the time. But it's definitely a problem they got to sort out. Otherwise, I mean, you can understand it though, right? Like if they keep holding this deficit, it just means that they have to add more debt to the pile each year. Like, that's just the reality, because you're spending more than you're making. You have to fund that extra somehow. Okay, you got to turn to debt to do it. You sell some bonds. And then, of course, we've got the double whammy at the moment, where all the bonds that they sell are being financed at much higher interest rates. And government debt that is coming due, that was taken on a while back, different periods of time back in time, that's coming due. And they don't pay it back because they can't, because they spend more than they earn. So they roll it over. And they roll it over at higher interest rates. So that's really the problem. And that's what these rating agencies are showing. I think now the US interest expense is the second largest expense category after Social Security. It's now higher than healthcare, which is crazy. So it's a really, really big chunk of that expenditure column. And that continues to grow because they stay in this deficit scenario. It keeps getting worse. And if interest rates stay higher, the problem keeps getting worse. So that's really what the rating agencies are concerned about, I guess.
Yeah, it is kind of funny because all of the... Oh, well, maybe it's not funny, but it's kind of concerning because all of these things kind of compound on each other because as the deficit gets worse, the ratings agencies kind of downgrade the credit quality of the US government. And that essentially means that they're suggesting there's a slightly higher risk that the US government won't pay you back. And so that means that investors would want to demand a higher interest rate on when lending money to the US government. And so that even compounds even further, making the interest costs even higher for the US for what they've borrowed. So it's I think, you know, Buffett spoke about this at the meeting, how it's a what did he say? It's like on an unsustainable path, but no one really knows where kind of the turning point is, or like the point of no return. It's just, we know that it's unsustainable, and but we don't know kind of at what point it'll really become a serious problem.
We don't know when we'll crash and burn.
No, we will if we keep going the way we are.
We will. We just don't know when.
But we don't know where the ground is. Yeah, the plane's in a nosedive.
We're just not sure when we'll hit the ground. That's a zinger. It's very interesting. And we've already seen some slight flow-on effects into this decision. I nicked this. Actually, all my stories this week come from the Daily Upside. So shout out to the Daily Upside. They say it should be said that Moody's, as well as competitors Fitch and Standard & Poor's, still consider the US a very low credit risk, as the country has a pristine track record of paying its bills. But even a slight change in attitude towards US debt can have major consequences, as Wednesday showed, because the US Treasury auctioned off $16 billion of newly issued 20-year bonds. But the government had to pay a yield of up to 5.046% to attract enough investors to complete the sale. That is considerably higher than the 4.81% when the Treasury auctioned off $13 billion worth of 20-year bonds last month, and compares with a 4.613% average for the past half dozen auctions. So already, this ratings downgrade, as you said before, Hamish, investors expect to be better compensated for this now additional risk that they seem to be taking on, because these rating agencies have rated the bonds or have rated the debt slightly riskier. Says here, a higher yield at one of the Treasury's regular auctions suggests weak demand because it means the Treasury had to offer greater returns to convince investors to buy government debt. Meanwhile, the current GOP spending plan, which narrowly passed the House in a pre-dawn vote Thursday and will now be debated in the Republican-controlled Senate, is projected to add $3.3 trillion to the national debt due to its inclusion of tax cuts and spending increases that aren't offset elsewhere. It also says, after the auction, the yield on the 20-year note rose to 5.125%, the highest since November 2023. Yields on other more widely followed 10-year and 30-year notes closed at 4.595% and 5.089% respectively, breaking through their traditional psychological barriers of 4.5% and 5%. A 10-year yield above 4.5% is viewed as a signal of inflation and growth risks, which can spook markets accordingly. The Dow Jones Industrial Average fell 1.9% on Wednesday, the S&P shed 1.6%, and the Nasdaq 1.4%. So I guess that's kind of the the flow-on effects to the ratings downgrade, kind of how it plays out, how it changes investor mentality and what it means ultimately in higher yields on treasury bonds.
Yeah, there hasn't been any kind of dramatic, I think, market reaction. Not too much, just like it's kind of a slight shift, but it will be interesting to see what happens with this spending tax cut and spending bill that Republicans are trying to push through.
Yeah.
And it seems like there has been quite a bit of pushback from kind of fiscally conservative Republicans who would probably like to see the deficit actually be reduced. So who knows how this bill or this law will actually look when it gets ultimately passed. But yeah, it doesn't exactly look like it's heading in the right direction.
Yeah.
So
a little bit worrying.
A little bit worrying.
Yep, the most interesting time we've ever seen in economics. I think Warren Buffett says something along those lines. So we'll see how it plays out. All right, let's talk about Taylor Swift.
Oh, fantastic! Let's do it.
I couldn't think of a segue. I couldn't. Normally, we love a good segue, but I don't know. Can you think of a good segue? How to get from that to Taylor Swift?
No, I can't think of anything.
No, we're just doing the straight cut. All right, well, next news story. We'll just have to splice an ad in there so that it breaks up the sections.
Yeah. Tell us about Taylor Swift.
Yeah, I will tell you about Taylor Swift. I won't actually tell you all that much about Taylor Swift, but I will tell you about the logistics team that ran her Eras tour. Of course, the Eras tour was, I don't know the statistics, but probably one of the most successful tours in history,
ever.
I would say.
Yeah,
probably ever. I can't think of anything that would have done better as like a worldwide tour. But the Eras Tour logistics team has been bought for $1 billion. So on Wednesday, the Wall Street Journal reported that Global Critical Logistics, or GCL, the live events logistics firm that kept Taylor Swift's historic Eras Tour world tour on track, was acquired by media and entertainment-focused private equity group Providence for the hefty price tag of $1 billion. Consider it a big bet on the future of live events. In Swiftie speak, GCL knows about it all too well. Providence's interest in GCL is no surprise. The firm powered the Eras Tour as it traversed 5 continents, 51 cities, and 149 shows. That's crazy. En route to generating record-breaking $2 billion worth of revenue. That placed Swift and GCL at the forefront of the post-pandemic explosion in demand for live events and entertainment. According to PricewaterhouseCoopers, the total value of live music ticket sales in 2023 reached $25 billion, with total revenue for the industry hitting a record $31.5 billion. Last year, Live Nation Entertainment reported record revenue of $23 billion. While the live events business has had a slower start in 2025, things could turn around this summer. In its first quarter earnings reported earlier this month, Live Nation, which is so dominant in the industry that the Department of Justice has accused it of operating an illegal monopoly, reported its revenues in the first 3 months of the year. They were down 11%. However, total ticket sales of 95 million through mid-April marked a double-digit percentage increase from the year prior. Wow. That was led by an 80% increase in stadium ticket sales. So that's the type of events that GLC pulled off every night of the Eras Tour. And the company has said that a 60% increase in the amount of stadium shows this summer could fuel a record season. So
crazy.
Although there are challenges still, it seems like this whole stadium entertainment gigs are well on the rise, and Providence wants a big part of it.
Yeah. Pretty crazy being able to do, what was it, 149 shows?
Yeah,
most of them, if not all of them, I think all of them were stadiums. Some of them would have been, enormous amount of ticket sales. I don't know, 80,000 tickets or something like that.
Yeah, well, didn't she do 3 back-to-back-to-back at the MCG, which is 100,000 people each night, which is just wild.
Yeah, it's it's insane.
It's pretty crazy. $1 billion, but I mean, yeah, if they can do $2 billion just on Taylor Swift's tour, that's revenue, I guess, not profit, but I think they're like, all right, we better pay up. But I don't know. It doesn't seem. You see, I actually watched the documentary on Woodstock '99 last night on Netflix. You seen that doco?
Oh yeah, is that the one that was burned to the ground?
Yeah, just ended in a total riot, just like a management nightmare.
Yeah,
but it definitely shows you that these events are not easy to do, and to do them well is a real skill. And I don't think that I don't know. Maybe I just haven't seen enough of it, but I don't recall any sort of big problems or big logistical nightmares when it came to the Eras tour. I think that's relatively went down without a hitch. Maybe I just haven't seen other stuff, but certainly the Australian leg, it seemed like it went pretty flawlessly.
Yeah, I didn't hear really anything negative about the Eras tour at all, to be honest. I just heard,
which is good.
Every local city was like, thank God she's coming, because of the huge increase in tourism and hotels and all kinds of things. So
I guess it's one of those situations where no news is good news. It's like you don't want to notice the event organisers, really. They should. Yeah. They shouldn't stand out.
No, they shouldn't be making headlines.
Yeah. So that was interesting. They say as well, this article says, it's not just about live music either. GLC already has logistics contracts for the 2026 FIFA World Cup, where host duties will be shared by the US, Mexico, and Canada, and has previously worked with the NFL. So the total value of the global live sporting event ticket market crossed $20 billion in 2024, according to Custom Markets Insights, and may reach $45 billion by 2033. Suffice it to say, there's a lot of money to be made by the Taylor Swift Travis Kelce power couple. That's their little sign-off remark. That wasn't mine. But there you go, $1 billion for a tour logistics company. That's pretty remarkable. All right, Hamish, tell me about the RBA rate decision.
Yes, we got a new RBA, Reserve Bank of Australia, made a new decision on interest rates, and for the first time in quite a few meetings, I'm not exactly sure how many, but it was well over a year, might even be 2 years now. They actually did something. They've actually done something. And it's in the direction that people would be quite happy about. So this week, the RBA decided to cut the official cash rate by 25 basis points, bringing the official rate to 3.85%. Wow. So
we did get a rate cut earlier in the year, Hamish.
Oh, did we? Oh,
yeah, okay. We got one in I think the February. We got 0.25%. Maybe you were just...
Well, there you go.
You were just overseas, doof.
Yeah, I
didn't even notice.
Clearly not paying attention. Yeah.
No.
So this is the second rate cut then?
This is the second one, yeah.
Okay.
Yeah.
Well, there you go. Why do you know? It's not even as important as I thought it was. But there you go. We got another rate cut, bringing the rate to 3.85%. Governor of the RBA, Michelle Bullock, said... the most recent quarterly CPI confirmed that both headline and underlying inflation are now under 3%. She did note the increased economic uncertainties, saying, since our last meeting, global economic and policy uncertainty has increased substantially following tariff announcements by the US administration, the response of its trading partners, and subsequent changes to policies, including various bilateral agreements and deals. And she said, quote, it's been a complete roller coaster, I'd have to say, which is probably quite a good way to phrase what's been happening this year so far. It has been quite the roller coaster. Who knows what's going to happen? Are we going to see more tariffs again? Are we going to see some deals? Who knows? But there's been a whole lot of
tough time to be a central banker.
Yeah, exactly. Yeah, I would not want to be making forecasts. I mean, it's a tough time being any kind of economic forecaster, but yeah, especially now, I don't think anybody really has any kind of idea of where things are going. She did say in regards to all of these kind of shifts in global trade, they did say that the RBA's overall opinion is that it would be overall disinflationary for Australia. Everything that's been happening. However, there is a risk of inflation on the other side. She said that the trade policies could lead to supply chain issues, which could raise prices for some imports, much as we saw during the pandemic. And so we'll need to be alert to such upside risks. So, as always, the central bank just making sure to make note of some of the potential risks, but trying to not be too pessimistic as to not kind of move markets with what they say.
Yeah, it's the same story that Jerome Powell's going through, I guess, at the moment.
Yeah, try not to shake the boat too much.
Yeah, inflation's not too bad, and then Donald Trump is doing all this inflationary stuff, and he's just like, caught in the middle.
Yeah, exactly.
Not news that hits you. You're not a mortgage holder, Hamish.
No, I'm still a renter, so yep. I'm completely unaffected by this.
Yeah, there you go. Love it.
Yep.
I'll take my 0.25% rate cut.
Yeah, thank you very much. Yeah.
Yeah, true. No, right. Interest rates have been really, really high on mortgages. It's been like 6 point something %. So, I don't know. I guess the next step is to see whether the banks pass down the rate cut or not. They might have even announced that. I'm just not sure. I haven't looked into it, but yeah. That's a quick one. Anything? Did you have more to say on that, Hamish?
No, that's it. Just a quick update. Tell us about this. Why don't Americans want to be 100 anymore?
Yeah, I just thought it was quite interesting. Because I don't know. I think we personally have different views on this. Because my personal view is I want to live as long as I possibly can. My take. Oh, you do? I thought you were saying I remember you saying that, you don't want to live until you're like really old and that kind of thing.
Yeah, I don't know. I think it depends on like the condition of your health. Like I wouldn't want to just like extend my life just for the sake of it. If I was in really poor health, but if I can be in good health, then absolutely.
Right. Fair enough, I guess. But yeah, this new report coming out of the States shows that most Americans don't want to hit 100. They don't want to live that long, which I find pretty mind-blowing. It says here that the number of Americans living to 100 or beyond is expected to quadruple by 2054. And for many, that's a scary financial proposition. Only 29% of respondents in a recent survey conducted by the Nationwide Retirement Institute in collaboration with the American College of Financial Services said that they even want to live to 100. And the reason is they cited financial and health concerns as the top worries. So financial concerns are one of the top reasons why Americans don't want to live longer, because they just feel like they're not going to have any money. It says here, indeed, about 3 in 4 worry that they'll run out of money before they run out of time. And 70% of Americans agreed that society is not prepared to meet the needs of people with longer lifespans. According to the joint research, 40% of non-retired Americans say they plan to delay their retirement due to inflation, which is all quite interesting. The quote here is, too many people underestimate how long they'll live, and that blind spot can seriously undermine their financial security. It's a quote from Michael Fink, who is a professor at the American College of Financial Services. So just 48% of Americans factor lifespan into their savings and investment decisions, and only 26% of respondents correctly estimated the longevity of a 65-year-old man, according to the joint research. Wow. Annoyingly, they didn't actually tell me, because I don't know what the longevity of someone that's 65. They didn't actually say it in their report, so okay, there you go. If Americans knew they would live longer, the data suggests, many would take meaningful action to improve their physical and financial well-being. This includes adopting healthier lifestyles, paying closer attention to debt, and carefully planning one's retirement date. In other words, mindset matters. Quote, the fact that the fact has been borne out in prior research from the college, Fink said. For example, we've shown that longevity optimists are 75% more likely to save at least 10% of their income, underscoring how a positive perspective can drive more financially secure retirements.
Interesting.
So,
yeah.
I don't know. Yeah, it's just a bit of a interesting couple of stats that just Americans don't want to live longer because they fear the financial aspect of old age.
Yeah, I guess it does make it tough because, I mean, even if you are going to live for another decade or two extra decades than you previously thought, it's not as if those extra decades are... You might not be in working condition for, that extra time. So it's just kind of extra retirement. It's like more time that you're going to be in retirement, which means more that you have to build in your kind of nest egg in the years that you have the energy to work. And are physically capable of working. So it does change the equation a little bit, and it's already something that people don't plan enough for anyway. Generally people are not that good at setting things aside today for the long term. And so yeah, it does. People living longer, I guess it does kind of change the equation a little bit.
Yeah, that's pretty crazy. Pretty crazy. That's one thing. I've been doing a bit of work with Drew from Model Partners, who's their Australian financial retirement planners. And he's always saying that one of the biggest problems he sees with his clients is they don't understand their own life expectancy. Right. It's like they don't... Of course, we always hear like, life expectancy for males in Australia or something, it's like 80 years or something like that. But that's 80 years for someone that's born today. And of course, as you live longer, your life expectancy actually goes up. Because you eliminate all of the unfortunate people that have died at a younger age than you are now. Yeah. So once you make it to like 50, your life expectancy is quite a bit above 80. I don't know what it is, but he was saying that when people hit retirement, they don't realize that their life expectancy is like closer to 90. And then some people that get older, like as you get older, your life expectancy goes up even more. So it's just... that he was saying that that's probably the biggest thing that he sees, that people don't understand how long they're going to live, probabilistically, of course, and they're not prepared for it. Everybody kind of thinks, I'm going to retire at 65 and I'm going to peace out at 80, but that's not the case anymore, and probably won't be the case, to be honest, as technology gets better over the next several decades, right?
Yeah, who knows? We'll be replacing our heart with a mechanical heart. Yeah. Start changing our parts.
I am 154. I look good for my age.
I don't know if I'd want to live to 150. 100 sounds pretty nice, but I don't know. Surely at some point it just you just don't want to live that long anymore. I don't know. It's hard to say. I don't know.
I feel like this is like my crazy wild theory. I reckon we'll get to a point where we could literally do a surgical position where a surgical procedure where we just like chop off our heads and plonk us on a robot, right? Yeah. Because the thing I think of, right, it's actually reasonably rare that the cause of death of a human is because your brain just is too old. Your brain just pieces out. I mean, normally you have a heart attack, or you have cancer somewhere in your body, and then it spreads and it overwhelms your body systems. But if we can get to a point where we can plug in some artificial running, blood through our brain and spinal fluid in our head, and then we just have a bionic body, like get around it. I reckon we could actually, I don't know, my washed opinion is we could extend our lifespan a little bit, I reckon.
I mean, maybe a little bit, yeah. I mean, neurological cause of death is pretty high still as well, isn't it, right? Like
That's,
people
I mean,
dying
true.
with dementia and that sort of thing, but...
Dementia, yeah, Parkinson, all this sort of stuff. Like, I mean, it's not foolproof, but I mean, it would definitely help, like, for people that would otherwise die of, a prostate cancer that spreads through their body and then overwhelms their body, or like a heart attack, which causes death of the brain, but the reason that the brain died is actually because of the heart. It eliminates that kind of stuff. Or we just go full Neuralink and just upload our consciousness into a computer. I wonder if that'll ever be a thing. I kind of hope so. Yeah,
as long as there's an ad-free version. As long as I don't have to get like that Black Mirror episode where I'm doing just getting ads.
That was really good. I like that episode.
Yeah,
I recommend it.
Episode.
It's the first episode of the new season, I think. I think it's the first one.
Yes, yeah, I think it is. Yeah.
Yeah, if you want a really thought-provoking, interesting show to watch, go watch Black Mirror. Watch the first episode of the latest season. Yeah, and it's kind of a take on subscription models gone too far.
Yeah, it's very classic Black Mirror where it's dystopian, but it's not so far out that it's actually that crazy to imagine. Which is the sweet spot, I think, for Black Mirror episodes where, it is dystopian. It's not a real thing, but it's just close enough that you could imagine that it could be real at some point in the future.
You're so right. They are the best Black Mirror episodes. The worst ones are always when they go too far. Yeah, and it goes from being like, it goes to being like pure fantasy. Yeah, like there's magic or there's something that's totally just cannot be explained in the realm of possibility. That's when it loses me. But when it's somewhat still grounded in like how our lives kind of function today, but it's just pushed to the extreme. That's when I find it's very interesting.
Yeah.
But anyway, you seen all of the latest season?
I have. Yeah. I thought they did a pretty good job. I think they definitely made up for some of the episodes of the season before was not that good. But I think they got a little bit back to their roots. Because I think season one and season 2 are probably the best, I think. For Black Mirror, but yeah, I enjoyed it.
Yeah, nice. Yeah, I've seen most of them. Some of them I liked, some of them I didn't. But I'm not really the guy that Black Mirror is necessarily for. I don't think. I don't watch a lot of TV. Right. I don't know. It's kind of hard for me to be impressed by a TV show. So. But anyway, I still thought it was good. It had some good episodes in there. Right, Hamish.
Here we go.
I think we're done. Dude, that was quick.
We are
blitzed
done.
Through that.
Yeah, we rocketed through it. Thanks everyone for tuning in. As always, we'll be back in the next episode to bring you whatever glorious economic and finance news that we have over the next week. Thanks, Brandon, for joining me as always. And
GG,
thanks to Seeking Alpha for sponsoring this episode. And we'll see you guys in the next episode. See you later, guys.